What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. If that sounds like something you're interested in, consider subscribing, as we do provide daily updates as well to get you prepared for the day and the week ahead in this glorious market. So, as always, before getting started, we're going to go ahead and pull this guy up right here, and then we're going to rock and roll from there. So as of right now, something I've stated, I want to kind of give again my main thesis of what's going on here. It has shifted ever since the banking crisis essentially occurred. Uh, I have pretty much done with the inflation side of things. I have moved on to essentially waiting for a recession at this point. Again, I believe we are in the final stage of this current cycle, this bearish cycle that we're in, and something that occurs in every major decade or so. You do have big events that are going to essentially crater the market. It's not saying that we didn't. The pandemic was a very out of the blue, once in a lifetime event. You have to understand that it's very once in a lifetime. So that is not really calculated into what was currently going on. Before the pandemic, we were aiming more towards a recession before it happened, and then that kicked off. That kind of accelerated everything, and then created new problems with the printing of 40% of the money supply. And so now we're pretty much living at a more amplified environment from that 40% increase in money supply to where we're currently at right now. But with that being said, let's look at the weekly recap. Now, as far as the banking crisis, it's been very, really quiet. So coming into this week, we were really looking at bank earnings. All those bank earnings were essentially on Friday morning, trying to, again, capture and make sure that everything was okay going into the weekend, because this next week coming up, you're going to get a lot of the really, really important earnings that are going to matter, because what we started talking about is the commercial loans for a lot of buildings since the pandemic. Since a lot more people are wanting to work remote, these commercial buildings are in trouble, and a lot of them are coming to maturity between now and 2025. And understand that a lot of the mid-size banks are holding these loans, and a lot of them are huge chunks of these banks. And so you have to understand that and with the increase in interest rates, we're going to see a lot of banks fail over the next, coming months and coming years. So with that being said, there's a lot that changed. There's a lot of data sets that were really important that occurred this week. But the banking crisis came out, obviously, with everybody doing bank runs a couple of weeks back, and shifted into a lot of the Big 10 banks. You have to understand you're going to see a huge uptick in these banks. And that's what we saw, right? But we saw a lot of weakness as well. And this is something you need to consider. Now, JPM is the number one bank, right? Their revenues is up 13% year over year. Revenues up. Your net income is 6.8. Again, this is the best bank. Negative 1.9 on net profit margin. Bank of America. Again, I think it's the number two bank, I believe, from what I've last seen. They're 8.5 year over year, 1.6 or 1.4, excuse me, to a negative 2.1 year over year. So you're seeing a lot of the margin go way down, and a big reason because of this is something else we are starting to see is people are pulling their money out of banks very, very quickly because of this bank run. So you're seeing a huge dip over the past multiple years, right? Because we've had over a decade of free money. And so with that being said, you're starting to see a huge decline in deposits just in general. So Wells Fargo, one of the worst on the board here at negative 8.8 year over year, 0% year over year net income, 19%, 19.9 year over year net profit margin. So Wells Fargo taking a big hit. Again, they've done a lot of shady stuff in the past too, so that's not really surprising there. Citigroup, 1.7. Again, if it's not the top five banks, these are the top five. So JPM and Bank of America are showing a lot of weakness, even though they're kind of the top banks. And then the rest of these are showing tons of weakness. And so Citigroup, again, I said 1.7 year-over-year revenues, and negative 21% year-over-year net income, negative 4% year-over-year net profits. Goldman Sachs, really surprising here, negative 13.8 on revenues, negative 66.7 on net income, and negative 19.7 on year-over-year net profit margin. So Goldman Sachs, hugest hit over this past week. And like I said, over this week, once we start getting into the earnings for this week, there is a lot of really important banks this week that are reporting. Like I said, with these commercial loans and everything coming up, are going to start really reflecting some really nasty numbers. And something coming into this week that I want to also point out is that there is a lot of weakness and a lot of stuff pointing towards recession. And this is why I talk about that next stage we're moving into. So we have to be very mindful of that. So core came out this week as well, came in at 5 versus 5.20 expected, and then the 6% previous. So it's good to see a gradual. Again, there's a lot of so there's such manipulation in this report, and understanding. You took away a year, so obviously it's going to start looking. The report's going to start looking better because you're trying to remove the average, right, of that other year that we had extremely high inflation. So these numbers are still very high, and then you still, even with that manipulation, you still have 23 consecutive months of inflation over 5%. So if that wasn't taken out, you would still have more months on top of it of negative inflation above 5%. And so this is why you see the manipulation going on, right? Because if that additional year was added, that would still, this consecutive months would continue for another 23 months. So again, recession numbers, they're hiding recession numbers the best that they can. But again, you can only manipulate reports so much before the actual numbers continue to get bad. And so that should show you that that average year that was taken out is still really bad. That is, you still got 23 consecutive months over 5%. And so we also got the Fed minutes, and that was very important because the low target interest rates, they considered lowering the target interest rates because of the bank earnings. We got that for the notes. We got that from the last monetary policy as well. So we were aware that they considered lowering or pausing rates. They also mentioned mild recession. Again, there's no such thing as a mild recession. And considering that we printed 40% of the money supply, you're going to see a very historic move, in my opinion, and what's going to happen with this quote unquote mild recession. Again, they've been saying soft landing. We've been pricing in a soft landing this whole time. This whole battle we've had all this past year and a half has been against interest rates, right? And oh, we're going to pivot. And you have a lot of people, a lot of investors thinking that we're going to rocket right back out of this thing very quickly, but you have to understand that it's not the way it works, right? Like you have to have a bigger cascading event to where it causes enough pain to where the Fed are going to have to lay off rates. And so there was so much greed in the market for the past 2 years that we've been fighting. This just been an up and down battle between the Fed and greed is essentially what it's been. And then again, they've kicked this can about recession. We haven't priced in a recession yet, and not to this extent. If you can look in the gray area and see the things that I've been pointing out here, the recession is extremely bad, right? What's going on here? People are skipping meals, right? Your average American is skipping a meal. It may not be something you're seeing, but everybody is getting affected, and it's getting worse and worse and worse. And considering we're aiming for another 25-point basis move is really bad. And so again, you're going to get more important banks this week. Once I start looking at the earnings here, you're going to get more important banks that hold specific loans that are going to be hit. And this week is going to be a very pivotal week because a lot of these really important banks, yes, the top 5, yes, they hold a lot of the deposit money, but the big problem is a lot of these other commercial buildings and stuff that are, again, coming to maturity are a huge concern and something that's going to cause very much a lot of repercussion moving forward from here on out. So, and then you have the 25-point basis move, like I said, and then you have the debt ceiling rate. It needs to be raised by June or we default. That's something we've been kicking that can every couple of months and fighting that ceiling. So that will be very interesting. Again, you don't want that to default. You'll see a huge crash if that does happen, because we've never defaulted, right? And so if that does happen, we're gonna get a massive crash on top of that. And 23 is on track for the biggest annual drop in commercial bank deposits in U.S. history. That was something I mentioned before, but again, just wanted to highlight that people are trying to buy assets, not only because of that, because of what's going on with BRICS, and their threat right now in this current environment. That is an actual threat, right? The BRICS has been around for a while, or BRICS, I should say, but it's been around for a while. But now it is a time that if it was ever to happen, it would be now. We're at a very fragile state. The world in general is in a very fragile state. So you have to keep in mind, other people have been talking about wanting to be less dependent on the U.S. dollar. So again, could be a potential threat. It's not something that's going to happen overnight. You have to understand there's a lot of trade and stuff that goes on that's based around the U.S. dollar. So that transition will, if it does occur, is going to be slow and gradual. It's not going to be quick, which again could lead to other things, right? Could lead for us to get into war, and understand that we've gone to war for very silly reasons, and for nothing in particular. So just be mindful of that. And so that's where we're currently sitting at there. So being said, coming into this week, is something I kept referencing is the banks are going to be a huge concern, because yes, they're your top 5 banks that hold deposit money and all that. That's great. But what really matters is a lot of these mid to smaller banks, they hold a lot of payrolls and everything else for a lot of companies. And some of these are even 90% of the close to 90% of the workforce. And understand that if these mid to small banks go under, you're going to get a ton of layoffs. We're talking millions and millions of layoffs. And then you're still talking about another 25-point basis move before the pause. So again, what matters is not so much inflation anymore, because if this thing crumbles and you lose, tons of jobs, you're going to get your deflation. And so it doesn't matter what inflation is doing right now. You're going to get massive deflation when everybody is losing their job and nobody can pay for anything. And this is when you're going to see massive floods on the houses and everything else. And understand that a lot of corporations and stuff like BlackRock have been accumulating tons of houses, and own a huge chunk of houses. And if they find that, again, that investment is not worth it anymore, they will flood the market. And that's the one problem we really haven't had in the housing industry yet, is we haven't completely killed that market and cause a huge crash, because there hasn't been a huge inventory of houses. And that would happen if BlackRock or somebody else out there was like, okay, well, this isn't no longer a good investment for us, so we're going to go ahead and just exit out of this. So let's flood the market with inventory. And then the people that are trying to survive and trying to sell their house, right, they're going to have to have huge price cuts at that point. And so this is the concern about what's going on with the housing industry. And so again, that is something it's a slow piece of the puzzle that moves very slowly, and you'll get more towards the back end of this thing. And this is why I said this could cascade into a bunch of different problems, especially when it starts with the banks, and then people start losing, these mid to small banks start losing, right, and failing. Then people lose their jobs, and then people start liquidating even more than what they have. Again, you're seeing a lot of delinquencies across the board, whether it's on credit cards or homes, or whether that's for automobiles, whatever the case is. You're already seeing a lot of these recessionary actions being placed. This is why I talk about the reality of the situation is things are really, really bad, right? And they're getting worse. And then you got the Fed that's continuing to push push rates down everybody's throat. And so it's still forcing the hand from this thing to get even worse than what it already is. But we're actually starting to see those numbers of a recession. And now the fact that they're calling a recession get you to panic. And this is where the market's going to, because they like everything else, they try to ease the market into everything, and they're going to call it mild, and then it's going to be 10 times worse because there's no such thing as a mild recession. So things are going to get 10 times worse from now. And so you have to understand this is where things are going to get bad. And then when we actually do price in a recession from where we're currently sitting at, that is when you're going to get a crash type scenario, right? And so, well, that being said, let's start looking at the upcoming week. Now that that's been explained a little bit more in detail, the Beige Book coming up this week. So this is going to give us insight into the next monetary policy. Understand that, again, we're looking at another 25-point basis move that is still highly essentially what the futures are pointing to is another 25-point basis move. If something big happens, if we get some more crashes or something, particularly with bank numbers or something like that, that will give more insight into what could cause the Fed to perhaps not lay it off. So that's, aside from that happening, we're going to get another 25-point basis move at least. So again, I think we're going to get to the point, the bonds are trying to price in cuts. I think we're going to get to the point where we go to emergency cuts is what's going to happen. I think if there's going to be any pause, it'll be very brief, if at all. And then we'll just start emergency rate cutting, because I think the Fed are pushing this too far, to the point to where the Fed needed to keep going just to break things. And I think just adding a 25-point basis move is accelerating this process to try to get a recession to happen quicker than it should. So that way they can turn and pivot. So the Fed can actually pivot, but they can't do that till you get this thing to break, and they know that, and so that's why they're continuing to press the increase in rates until it happens. But again, the banks folding and the banks actually breaking, having some big banks breaking, they found that point. So that's why they're only doing 25. There's no need to go 50, because you go 50, you're going to do too much damage and possibly risk your top five, some of your top five banks to go under. So we'll raise it by 25 and see how bad it is, right? So now that you know the breaking point, you're kind of just tinkering with it that way that it can break in a controlled fashion. So that way you can hurry up and apply decrease in rates. So that way you can kind of control the fall, because then at that point you're going to have a recession, and then you can actually pivot and start cutting rates, and then potentially lead into quantitative easing next year and perhaps printing more money or whatever the case next year, which is a strong possibility, because I think you're going to have a very hard recession, which is going to last. I think you could recover very quickly off that, but again, you needed to break. We haven't broke. And that's what I've been trying to explain for the past, it's been about a year and a half, but we weren't dealing with a recession at that point. We were dealing with more so coming off of quantitative easing and easing into interest rates. And so you have to understand that you go through that cycle, then you go into a recession cycle, and we're, again, final stage. And then you can, after that point, you could have a fast recovery. So Beige Book will give us insight into the next monetary policy. Monetary policy is on the 3rd. Next core inflation is on the 12th. Now, upcoming earnings. Again, there is a ton of earnings on here, something I state every earnings cycle, but these are the particular ones that I'm watching. Again, there's a lot of banks. I could list a lot of like mid-sized to smaller banks that are going to be extremely important to watch. Again, when you're going through these sessions, you know what the endpoint is. It's easier to depict the endpoint, but you don't know how it's going to happen. That's why I do daily updates, because we're not really sure what's going to happen. And so there could be a particular bank that reports something that causes the whole thing to crumble, right? You don't know, what's going to happen, but you just don't know what that key player is that's going to be the one thing that drops everything. And that's what's always hard to depict. You can't really depict. So you try to have a broad horizon, cast the net broadly, and then you kind of see what happens, right? But again, it's easy to depict what the end game is going to be. You just don't know how we're going to get there at some point. So it's, again, not trying to have still an understanding that you can still play intraday, you can still play monthly and stuff like that, but I don't try to cast that net too far because again, if you try to predict, well, this is going to happen, right? You don't know. Like this is a very accelerated process, and we've seen that along the way. And so after this, my thought and theory about the whole thing is that okay, you can still take advantage of a month or two, but realize that you're coming more into risk, right? Because you're starting to see signs of other things, and so you can pivot from that point. So again, with that being said, upcoming earnings Tuesday we got Boeing, we got Goldman Sachs. I believe in the morning, and then you got Netflix this afternoon and that afternoon. So that will essentially give us insight as the first big tech. We'll get some big value. Boeing's already been selling off. That because of they're missing some production numbers. Goldman Sachs, like I showed you, is going to be really nasty already. Wednesday, we got ASML, so we got some important chip information there we need to be watching. You got Morgan Stanley, another bank, Ally, another bank in the morning. Then in the afternoon, you got Tesla, you got RS. You got Lam Research, which is essentially, again, more chip news. We're going to find out Thursday, TSM, more chip information. And then again, between all that, there's a ton of banks again reporting this week. So we really, really got to watch and see what is happening with there. Then, as always, this week, again, normally we start getting earnings. It's not a big pivot because again that's why I point out monetary policy and stuff because it's a bigger pivot to the general index, to the general market. So you start seeing a bigger uptick in the actual individual stocks as far as like options are concerned, and the price didn't move, as you can see. And Tesla is reporting on Wednesday, so you see that we dropped last week, I believe, to it was like 13 or so. Now it's bumped back up to 15. BA has still been very high, especially because it's been volatile with the numbers that have occurred last week. JPM has dropped down because they are done reporting, so they're about back down to average, right? And before we've seen JPM during the banking crisis was up to 7 at one point. And so this is why I always bring this up, because it's important to see what is going on in the options market and how they're trying to price things in, because these are their scheduled events, right? And so if there's going to be a big pivotal event like monetary policy, then obviously you're going to see SPX jump up to 110 right that week, because this changes the dynamic of the market. And so that's why you needed to pick that and understand what's going on with watching those options. So I think we're good with this. There's a lot going on so far. We haven't even gotten to technicals. Again, technicals, I think, are pretty straightforward going into this week. We've been playing top of the range. We haven't broken out. And so, again, something I always like to pick out, people are calling a new bull market. Look at this. Look at this chart. Even if you don't know what charts are, does it look like anything has changed? Nothing has changed, right? So how is this a new bull market? This was our last earnings cycle here, and then right after the earnings cycle, we sold off. New earnings cycle, sell off. Potentially even more, right? In my opinion, because I think at this point we're starting to see recessionary numbers. And if you want to bring this up even another notch to the monthly, right, this could potentially look like a breakout right here that we could actually pump out of here. But the problem is, again, we haven't repriced in a recession. This has been a battle of just interest rates. That's all this has been. Right, we sold off naturally, and I've just been battling. Now, if we price in a recession, could break lower into this level. Again, this is what I've marked. It's been essentially all prices being normalized is down here. So anywhere essentially between the 3,200 and the 2,786. That is normalization. That's what the market needs, right? For us to go back to a place where people can afford things just in the general market, right? When I'm talking about automobiles, when I'm talking about housing, when I'm talking about just food and everything, the market needs to be down here. This needs to happen. This needs to normalize down here. But you have such greed that is pushing this thing back up because of this. A lot of people that have just started investing are used to this because you got 2 years of this. This is pandemic right here. 2 years of this. People are professionals at investing. So now you're having greed just come in and, we're going to go back to all-time highs. You need a natural cycle to go back to normal prices? Do you want to still pay, 50, 60% on eggs because people are greedy? We need a normal cycle where people, and this is why the Fed have been doing what they're doing, continue to push rates, because they're trying to crush all cash flows of people, right? That's what the Fed is trying to do, is destroy cash flow by destroying any jobs that are left out there. Um, so that way people have to sell their assets. They can't go wander off and just do their own thing anymore, right? And so understand that because of that, the Fed is trying to normalize things so prices go back to lower rates, so it's affordable for everybody to be able to own a house and own a car and just live their life, right? It's not ideal. I mean, if you are a entrepreneur or something like that, the markets are extremely hard in general, right? They're just, people just aren't buying. The people are in the survival mode, and so they're only buying those things that they need, not that they want. They are selling the things that they wanted back during the pandemic that they bought because money was easy. Now we need normalization down here. Will we get down there? We don't know. I mean, we will see. The Fed are still moving in a fashion that they are trying to normalize the market. And that's why they continue to push 25-point basis moves. And also why even a pause is enough to continue that thesis for the Fed that things will normalize down to this level. Because this is recessionary levels. You need to get a recession to get down here. It's not saying we can't hit this and then wick straight out of there, because I think that's very much possible. People are a lot more educated about markets now than they were then. But being said, I think you still need at least a 3,200 hit before this happens, right? Before you start seeing more normalized prices across the globe. Understand this is global. Understand that Europe is still very much falling apart, right? They affect us because they hold a lot of bonds. This is a debt-based system. You have to understand how the economy works, and that if they go under, we're going to be hit, right? Because they hold a lot of our bonds, they hold a lot of our debt, and so if they go under, we will go right with them. It may be very delayed, but it's going to happen, right? Like, there is no scenario in which this thing is just going to run back to all-time highs and everything's going to be fine and dandy. All you're doing is prolonging the inevitable and being greedy, right? That's what this is. If we pop out of here, that is sheer greed. That has nothing to do with things are okay, right? And then why I have this channel, why I talk about these things, because things need to be normalized. We need to get, if we're trying to allow everybody in the spectrum to live, this quote unquote ideal lifestyle where you buy a house and you buy a car, and you're working 60 years of your life, that the Fed tried to cram down everybody's throat, then with that being said, you need normalization. And to be able to do that, you're going to have to crush everything in every aspect, in quantitative tightening, right? It needs to happen. And so with all that being said, that's where we're at. So we'll see what happens on the SPX here. But again, looking at this for the week, bulls, you need this to break the 4,200, really. We haven't quite touched that. There's been heavy selling coming into this thing. So if you break into that, all that's going to put you into the next bracket, the 4,300. Again, the general market is not changed. Until that changes, you're not going back to all-time high. You're going to do the slow, nasty chop up if that is possible, or we start getting a lot of recessionary numbers and the market gets scared and prices in a recession. Again, the Fed have mentioned mild recession. Let it sink in. We see what happens going forward the next couple of weeks. This thing could start selling off back down to 3,800. Again, depending what news comes out, if it does start selling, could accelerate this thing down even further. So we'll see what happens there. Bitcoin. Let's take a look at Bitcoin real quick. Again, Bitcoin home on 30. Again, I don't think this is going to decouple as of right now. I think this has still got one more pullback before anything happens. It's going to make a new low. Again, really depends on what happens there. If you want this thing to decouple, it needs to be tested by the market and pricing in a recession. All right, that's different. That's not anything else aside. When's the last time Bitcoin has actually gone through a real recession, right? It was created during the last recession, right, that we had, the last major recession that we had, and then understand that it hasn't really been tested going up against that, right? Like, for this thing, I don't think it's going to decouple until you get this last cycle, right? And then I think crypto will explode after that, but you have to let the cycle normalize. You need everything, all markets to normalize, and then that's when you break away and you explode, in my opinion. So we'll see. But I think that's where Bitcoin is going. Again, if you think this thing is, like I said, in the monthly, this thing can push up to 40K before that happens. 35K, strong possibility before this thing starts potentially selling off. Again, on the monthly, looks like a dead cat bounce. But again, that's just my opinion. So we'll see what happens there. But that's what we have for that. Let's take a quick look at gold. Again, gold, this is recessionary. Gold doesn't move like this unless you got recession concerns. And so, again, this could be a pullback for gold. That's hitting support here. Could start, again, this is a stronger bull technical move here, because you have some actually good size pullbacks and then bounce off support. Good size pullback, bounce off support. It's naturally pushing up higher. So, and again, gold moving like that just means people are concerned about a recession. Now, Tesla, looking at the daily, again, Tesla going into earnings, it's been really rough. And again, they slashing prices on the Model 3 yet again. So we'll see what happens coming in earnings. If this thing does want to pop, I think it's gonna, again, you're gonna have that ceiling roughly around that 220 mark. So it could push up to there. We'll see what happens. Aside from that, you don't want it to hold the 177 if you're a bull. Bears, you want this thing to kind of really break below the 167. If it does break below that, like I said, it's going down to 140. I believe it'll be going down to 140. Whether that's I think more so after the earnings cycle, you have to let the earnings cycle play out, and then I think you're gonna drop down to that 140 level. So with that being said, we'll see what happens with Tesla. Again, these are the ones we really want to be watching, because after this following week, we're going to have Amazon and Google and Microsoft. So you want to see, again, we're looking for weakness. We're looking for forward guidance, especially, again, looking for recession type numbers, recession type scenarios are what we're starting to look for in the earnings. Those are the kinds of things that we want to see. If there's any more layoffs, is going to be huge for these companies. So those are things we definitely want to be watching moving forward here. BA, huge gap down again, production cuts on their numbers. So we'll see if this comes down. This thing never wants to sell. Again, it never hits expectations, right? Like, this thing is backed by the government. So it does very, very poorly and losing money constantly. But again, it's backed by the government. So it somehow manages to stay up, and this thing is somehow not $50. I don't understand how it's not, but nonetheless, we'll see what happens moving forward. Bulls, you need this thing to break out the 220. Bears, you need this thing to break below essentially the 193. So we'll see what happens there. JPM, massive rip. Obviously, the huge amount of deposits that it got over the bank run has obviously helped this thing, shot it right back up. But we'll see, right? Now we see if this thing can hold, if this thing wicks back down coming into this week. But ultimately, you want this thing to hold 136. Bulls, you want it to break above essentially 145. Which I think it can push for a couple days after earnings. If it gets really good earnings, it could push for a couple days. My key thing is to really watch this top level here. We're on the 145 and see if it can actually break that. It will help the market from selling. Now, if there's a lot of concern about recession, this isn't going to matter. It could start selling off pretty heavily. But we'll see if it can hold at 124. If not, we'll go from there. Goldman Sachs, again, like I said, is earnings. It's essentially because of the great earnings essentially that came from JPM. It's obviously been pushing up since then, but we'll see how they do report coming into this week and go from there. But ultimately, looking for this thing to break out from the essentially the 348, but you have to look, this thing just broke and is now retesting. So if it can't break essentially the 348, things are to turn around and start selling off. Is this the retest and the dive? That's the question we're asking ourselves. We want to see. Bank of America, again, just had earnings, so we'll see how this does play. Again, they're showing a lot of signs of weakness, right? And so that's the key, the thing. But if we are pricing in a essentially recession that's going to be concerning. And something that did come out again on Friday that I did not mention is the Michigan consumer inflation 5-year expectations. People are actually concerned, and we haven't been concerned like this since the last major recession, because of the fact that people are worried that what if inflation does, right? You're coming into that seasonality in which inflation starts to rise naturally, right? Because people are trying to take trips and everything else, and so that is a huge concern coming in the next quarter here. So people are expecting inflation to push back up, and if that's the case, again, that's going to be a bigger problem. That's just going to cause the Fed to lay on potentially another 25-point basis move, or hold rates for a longer period of time. Because again, we are at the point of where it could cause massive amount of disinflation if there starts being more and more massive layoffs. And again, the cascading effect, these middle small tier banks, they start going under. Tons of payrolls are going to be lost, right? There's just, this thing is getting to be extremely nasty, and it's just a ticking time bomb at this point. And I'm not one of those bears that go out. I'm not a bear in general. I'm very much a bull, but at this point, I'm trying to let this natural process play out before we can get into that next cycle. I do believe the next cycle is going to be very strong, but you have to let this normalization occur first, right? And it's not even close, right? We need to price in a recession. Once that recession is priced in, then we can naturally start pushing back up and normalizing all prices before we go from there. So with that being said, you made this far, I do appreciate you. Go ahead and drop a like, and I will see you guys on the next one.